man who I think can make tax sexy, David. Please come join me, and you can take it from there. So, thank you very much.
I'm not sure about making tax sexy, but we'll see what we can do. So for those who don't know BDO, we're an international global accountancy firm in about 150 countries around the world. In the UK, we've got offices all over the country, and this is a sort of area that we like to focus on. And what I'm here to do today is to talk to you about EIS. I'm a tax partner, a specialist in EIS and venture capital reliefs generally. And so before we go into EIS, though, it'd be good just to perhaps talk in a bit of background about the types of relief available to investors. So on the board there, you can see there's EIS, which we'll talk about, the CDIS for the smaller, newer companies with a slightly enhanced tax relief. There's also entrepreneurs relief, which many of you will have heard of, for those who are working in the business, for employees and directors who have more than 5% of the equity. And there's a new relief, investors relief, for those who are not employees or directors, who can also get 10% capital gains rate on the first 10 million of gains. And business investment relief mentioned there, that's a relief for UK resident non-domiciles who, in the past, if they brought cash into the UK to invest in companies, would be taxed on the remittance. This relief allows them to bring it in and then invest in companies. And it's designed to work alongside EIS, so they can bring it in without tax and then get EIS relief as well. But we'll focus on EIS. So EIS, just by way of background, is intended to give a tax relief to encourage investors to invest in newer, unquoted companies, which by their nature are more risky. And so that tax relief just gives that extra boost on the upside, but also some downside protection as well, which we'll talk about in a minute. It was also designed to solve the funding gap. So often newer companies find it difficult to get bank finance. The banks will say you need more equity. And so this relief is to assist companies to do that. So what are the reliefs for EIS? Well, there are a variety of reliefs. The first one and most known, I suppose, is the upfront income tax relief. So if somebody invests £100,000 in a business, they can get 30% relief. So they'll have a reduction in their tax bill of £30,000. Obviously, that requires you to have a tax bill of £30,000. If the tax bill's £20,000, you only get relief up to the amount paid. There's also a deferral relief. So gains, even gains going back 3 years, if you've made a gain of, say, £100,000, you can invest that into an EIS company and defer that gain until the EIS shares are sold. So that could defer a gain at 28% or 20%. Just at the moment, it's possible to defer a gain that was taxed at 28%, and then when the EIS shares are sold, it's taxed at the prevailing rate of CGT at the time. So if that's now 20%, as well as a deferral, there's an absolute saving from 28% down to 20%. So there is a bit of a window of an opportunity. Obviously, we don't know whether CGT rates will go up in the future, but that's certainly the position right now. There's an exemption from capital gains tax on disposal after holding the shares for 3 years. That's reliant on qualifying for the upfront income tax relief. But again, that can be very valuable if you invest in a portfolio of businesses and one of them makes a 3 times, 5 times multiple, and that gain's tax-free. That's a huge benefit. There's also loss relief. So obviously we don't want to make losses, but if a loss is made, typically you end up with a capital loss which can be carried forward and set against future capital gains. But with EIS, you can set that loss against other income and get relief at 45%. And again, I'll cover that in a minute. And then finally, inheritance tax. If somebody qualifies for EIS, they'll qualify for business property relief, which exempts the shares from an individual's estate after they've held them for 2 years. So I've put an example here. I've called it best case scenario, but it's probably a misnomer because you have to actually die to get all these reliefs. So it's not really, it's best case from a tax perspective, but maybe not from a personal perspective. But this is the kind of thing you often see in prospectuses, that there's the upfront income tax relief, a CGT deferral, which on death becomes a permanent saving. Then there's inheritance tax relief. That's good. And then there's the relief from inheritance tax. So you can get 98% relief provided you die at the right time, which is great. So worst case scenario, if you thought that wasn't the worst case scenario, obviously some companies will go bust that are invested in an early stage. So what happens there? Well, the £7,000 in that example, net of the income tax relief, is either a capital loss, as I said before, to carry forward and set against other gains, or by election, you can set it against your income for the current year or the prior year, which means getting relief of up to 45%. So provided you can shelter that, you can see there the net loss. Obviously, we don't want to make a loss, but if you do make a loss, at least it's only 3,850 in that example, 38.5% because of all the tax reliefs that have been given. What are the investor requirements? Well, to get the full suite of reliefs, the income tax relief and the CGT exemption, there's a limit of £1 million per tax year. You can carry back a year, so get £2 million in any one investment. The investor can't be connected, which means not having more than 30% of the shares, not being an employee. It is possible to be a director provided you meet the so-called business angel provisions, so provided you get the shares first and then become a director subsequently. There are various anti-avoidance provisions out there. A couple of the points at the end there, though, no value received from the company. There are provisions to stop someone putting money into a company and getting tax relief and then taking it back out by another means, as you probably would expect. An EIS investor mustn't hold any other shares. This is a new rule. So in the past, you could have an investor with some shares that weren't EIS qualifying, and then later on invest some shares that are EIS qualifying. Now you can't do that. If you've got non-EIS shares, you can't personally then have some shares that are EIS later. And that's an important point, that the tax-free disposal can't be claimed unless some income tax relief is claimed. You do get some entrepreneurs who, all their money's tied up in capital, and they get some years where they've got little income, perhaps covered by personal allowances. And if you don't claim the income tax relief, you're not eligible to claim the tax-free exit after 3 years. So that can be quite a trap for some. So what kind of companies qualify? Well, the company has to have fewer than 250 employees, gross assets immediately before the investment of no more than 15 million. And there's a maximum that a company can raise from EIS, CDIS and VCTs of 5 million. And that 5 million is on a 12-month rolling period. So you look back 12 months and in that period you can only invest 5. There's a new lifetime limit of 12 million that came in from November 2015. And another thing that came in from 2015 is this trading period. So the company has to raise the first CDIS or EIS money in its first 7 years of trading. There are a couple of exceptions if a company is going into a new geographical or product market, but that's pretty difficult to meet those conditions. They're so tightly drawn. So ideally, that money needs to be raised in the first fundraise anyway, needs to be in the first 7 years. The shares have got to be unquoted. The company's got to be unquoted, which includes AIM, and the company's shares that you're claiming have to be new shares, new subscriber shares, fully paid for. I mentioned there a qualifying trade, so I'll talk in a minute about, there's a definition of what's not a qualifying trade. And you can't have pre-arranged exits, protection against risk, again, various anti-avoidance provisions. So that's a list of the excluded trades. So you can't carry on any of these activities in a company to any significant event, where significant is defined as 20%. Now the question then is 20% of what? And there's no definition of what. So we get to discussions with HMRC about whether it should be 20% of turnover, profits, management time. Obviously we'll choose the one that suits us and HMRC will choose the one that suits them. So you get into a bit of a horse trade about which is the most appropriate measure. So the things that are on the list tend to be property-backed, or there are a few anomalies. So hotels don't qualify, but pubs do, for example. And there are a few things on the list where you might think a company wouldn't qualify, but actually, if you do a bit more digging, you find sometimes it can. So even if it's on the list, it's worth just asking the question. The shares can't have preferential rights to dividends or assets on the winding up. Again, the revenue have quite an unusual definition of what preferential means, so that's another thing that's worth looking at. But these are the changes that came in November 15. So that because EIS is state aid, the EU state aid rules changed, and therefore the EIS rules also had to change. That might not be the case in a couple of years' time, obviously, but that's the position we're in at the moment. And so there's now a lifetime limit of 12 million, or for knowledge-intensive companies, it's higher at 20 million. We mentioned the fact that there's an age limit, so it's got to be in its first 7 years. And the money can't be used, in the past, the money could be used to acquire shares in another company or a trade. That's no longer possible. So there's a real focus on it being growth money, which is probably a reasonable direction to go in. But we are a bit concerned on the second to last bullet point there. The money must be used for growth and development of the company. The Revenue's interpretation of this in their draft guidance is that therefore the money can't be used, for example, to repay some existing loans. It can't be used to cover existing expenditure. So in the past, if you had a loss-making EIS company, you might raise some EIS money just to keep it going until the revenue's built up into a profitable situation. That's no longer possible. The Revenue want to see evidence that the money being raised is going to be spent on employing more people, growing the business, and all those sorts of things. So some would say that's a good thing, but it's also quite restrictive. So there has been some lobbying and some response in a consultation document. There's also a technical point about, in the past, before you could raise EIS money, you had to spend 70% of the seed EIS money, and that's now gone, which is helpful. And then finally, on the advanced assurance application, it's possible to write to HMRC to ask them whether the company qualifies, whether its trade and its business qualifies. And so we recommend that companies always do that, because if you break the rules, you can't retrospectively go back and correct the situation. So it's always good to get that clearance and make sure you see that clearance as an investor. Because the rules have changed, particularly since November of 2015, sometimes you can't just rely on a previous clearance application. It's good to get that looked at. And it's also worth bearing in mind HMRC are currently taking about 8 weeks to deal with these advanced assurances, which is an awfully long time when a company's trying to raise money. So we are seeing now companies really struggling to get those advanced assurances just because of the shortage of time. So that's another thing that the Revenue are aware of. There's currently a consultation document, and hopefully that will change. So it's a bit of a whistle-stop tour of EIS. Hopefully, some of you I know will know more about it than others, but I will be around at the front afterwards or in the back. So if anyone's got any specific questions, then by all means, come and find me. Thank you.